I'm Chad Justice. I'm the president and CEO of Collaborative Wealth. We're just now finishing up a strong 21, and I wanted to provide my early thoughts on 2022. With the fourth quarter underway, historically the best quarter for stocks, by the way, 22 is fast approaching. While a lot can still happen between now and the end of 21, we don't think it's too early to start thinking about what stocks might do next year. We see a favorable economic environment for stocks in 22, consistent with prior mid-cycle expansion years and bolstered by continued earnings growth. The gains might not come easy, with a number of risks such as COVID-19 related supply chain disruptions, inflation, and higher interest rates. But we start top down. As 21 winds down, we're starting to look ahead into 22. As a starting point to begin forecasting stock market performance next year, we want to first assess the economic growth outlook and where we are in the economic cycle. If we are approaching the middle of an economic cycle that has at least a few more years to go, then we believe the chances of another good year for stocks in 22 are fairly high. Mid-cycle simply means we don't believe a recession is likely anytime soon, nor do we expect the big equity gains typically seen when the economy emerges from recession. Looking back at the past 50 years, the S&P 500 index was up an average of 12% during the 27 mid-cycle years we identified, with gains in 81% of those years. We also acknowledge that stocks are up a lot and valuations are elevated. The S&P 500 is up 16% year to date and 95% since the March 2020 low, which to us means the probability of another big year in 22 is relatively low. However, with the economy poised to grow, the chances of solid gains remains fairly high. Earnings are a key piece of the puzzle. A growing economy is a great start, but stocks fundamentally derive their value from their earning streams, and earnings start with revenue. The environment for companies to grow revenue next year should be excellent, with above average potential economic growth and some pricing power from elevated inflation. Historically, S&P 500 revenue growth is well correlated to nominal gross domestic product. Nominal GDP growth is real GDP growth plus inflation. Hypothetically, 4% GDP growth next year plus perhaps 3% inflation puts 7% revenue increase into play. Without any change in profit margins and some share repurchases to lower the share counts, a near 10% increase in earnings in 22 looks to be within the realm of possibility, which is reflected in current consensus estimates. Significant earnings momentum is also bullish, with estimates having been raised significantly by analysts over the past 6 months. But COVID-19 related supply chain issues and material and labor shortages may push costs up and pressure corporate profit margins in 22. Several companies have already warned of such pressures ahead of third quarter earnings season. As a result, we're forecasting S&P 500 earnings growth of 6% in 22. That's 218 per share after 205 per share in 21. However, higher corporate taxes, which we see as likely, may eat into much of those earnings gains in 22. So while we anticipate stocks will get some help from earnings in 22 and expectations for more earnings growth in 23, uncertainty is clearly high. As we think about where stocks might go in 22, we want to assess where valuations might be in a year and what type of earnings growth markets may be pricing in for 23 at that time. Looking at valuations first, they are elevated, but strong earnings gains during the ongoing economic recovery and recent stock market pullback have lowered the PE ratio for the S&P to about 20.5. Interestingly, the S&P 500 is up 16% year to date, while the consensus estimate for the index's EPS in 21 has risen 20% since January 1st, showing that stocks are actually cheaper now than they were at the start of the year. We believe still low interest rates justify current valuation levels, but if rates rise next year as we expect, PE multiples are unlikely to rise and may edge lower. That means earnings growth will likely be the primary driver of stock market gains in 22. Turning to earnings and looking beyond next year, if we assume the S&P 500 EPS growth returns to its long-term average in 23 of about 9%, while the PE stays at that 20.5, the S&P 500 could be fairly valued at 4870 at the end of 2022, or 12% above the September 30 close. That seems like a reasonable place to start, though it's not our official forecast, with several percentage points of gains potentially coming in this fourth quarter. The upside to that could come from valuations if interest rates stay lower for longer. The downside could come from margin pressures, particularly wages, which could chop a few percentage points off of earnings growth over the next year or two. In summary, it's not too early to start thinking about 2022 as the fourth quarter gets underway. Prospects for above average economic growth and further earnings gains next year point to another good year for stock investors. We expect interest rates to stay low enough to justify maintaining current valuations, which could set the stage for double-digit returns for the S&P next year. Look for more on the earnings outlook in an upcoming commentary previewing third quarter earnings. And once earnings season gets rolling, we'll get rolling on writing our full outlook in 2022. Finally, for those more concerned about finishing up 21 than what 22 may have in store, we would not be surprised to see a bit more volatility around China, COVID-19, the Federal Reserve taper, high inflation, supply chain disruptions, and of course, Washington, D.C. headlines. We would look to be buyers on those dips given the mostly favorable macroeconomic backdrop, low interest rates, and historically strong fourth quarter returns. I'm Chad Justice, and until next time.